This is Harry Dent. Just want to give a quick update after the recent Fed meeting in September where the Fed actually surprised the markets. I mean, the markets were actually ready to have the Fed taper 10, 15 billion dollars a month, cut back their stimulus program and not punish them severely for it, and the Fed did not take that invitation. Very surprising. Now, first of all, it tells me Ben Bernanke's not as confident that we're in a sustained recovery as everybody thinks he is. More and more economists, every time I get on CNBC or any kind of public debate, everybody's like, hey, we're finally in a sustainable recovery. I'm like, no, we're not. It has been taking $2 trillion of stimulus a year, roughly. In other words, currently $1 trillion a year, $85 billion a month in QE, and on average in the recovery since 2009, $1 trillion in fiscal deficits. That's how much stimulus the government's putting in the economy. And what are we getting for $2 trillion a year? 2% average real GDP growth. That comes to about $350 billion a year. Would you invest $2 trillion a year to get $350 billion in GDP? That doesn't sound like a very good deal. That doesn't sound like a sustainable recovery. It's not. One of the things I've looked at recently is that there's a 7-quarter cycle in this stimulus. Stimulus doesn't work but so long. When you're putting money in the economy and you're pushing interest rates artificially low, short-term and long-term, what you're doing is encouraging people to buy now something they might buy, say, a year or two from now. You're pushing forward demand into the present. So you're borrowing from the future, and stimulus is borrowing, and the government creating money out of thin air is borrowing. Banks making loans out of thin air against tiny reserves is borrowing. When governments and corporations issue bonds, it's all borrowing. It's fine to borrow an appropriate amount against your needs for housing or cars or stuff like that, but it's not fine to borrow more than you can afford in the future. It's not fine for debt, and this is what happened. Government and private debt, if you put them together, grew 2.7 times the economy from 1983 to 2008. How could any economist not see that as a problem? What has the Fed done since that debt bubble unraveled and since the baby boom slowed in their spending after 2007, as we predicted 20 years ago? They've been fighting this downturn with endless stimulus. And like any drug, it takes more and more stimulus. You stimulate, it's like a cup of coffee or crack or anything. It makes you feel better for a while, then it wears off and you actually feel worse. I mean, it's that simple. It's artificial. It's not real. It's not coming from aging, rising productivity, technological progress, real investments in plant and property that create real long-term jobs for real long-term consumers. Housing's bouncing back, but most of it is speculators. Pension funds, hedge funds, buying houses cheap, turning around renting them to people who can't afford to buy them now or too scared to buy them. That's not a sustainable recovery. But the real facts come when you just look at these cycles. We had the Great Recession that bottomed in early to mid-2009. Well, the Fed had to come in with massive QE1, massive, unprecedented buying of bonds, injections of money in the banks to keep the banks from failing, the whole economy and financial institutions from melting down. You know what we got? We got 4 quarters of growth after that, and then 3 quarters of decline. The stimulus wore off, and then we were at minus 1.2% growth in the first quarter of 2011. In other words, we went back in recession because stimulus does not work long-term, and it's not sustainable recovery. Well, then we got QE2. We got 3 quarters of growth, and we got the highest growth in a cycle, and then 4 quarters of decline in the fourth quarter of 2012. Guess what? We were back at 0 growth again, back to nothing. Well, now we're 2 quarters into this. The growth in this expansion is not as strong as QE2, even though QE3 has been steeper and stronger and longer than QE2. It takes more and more stimulus to have less and less effect. You know what this cycle tells me? Even if the Fed doesn't taper, and they probably will have to taper in coming months, I think third quarter is going to be stronger. First, second, third quarter next year, we're going to go back to 0 again. And I mean, and I've got much bigger problems in Southern Europe, much bigger problems. The bubble looks like it's about to burst in China. But just on this alone, we're going to slow in the first 3 quarters of next year, even if the Fed doesn't taper. So do you want to be in stocks that keep going up? We see a peak in the stock market in the first quarter of next year, between mid-January and late March, and the next great crash to come. Every bubble's taking us higher. Every crash takes us lower. if you're worried about your stocks, your financial assets, you will protect them. And if we don't see a major crash by the summer of next year, then I'll back off and say, hey, maybe the government's pulled another rabbit out of the hat. I think they're running out of ammo. I think the next crash is just around the corner. Thanks for listening.